So this week we are learning about job order costing, right? And how does that differ from process costing? We use job order costing when?
Customized orders.
Customized orders, so when we can connect the costs to the specific jobs, then it's appropriate to use job order costing. If we're just mass producing the same product over and over, then we wouldn't do that. We would use process costing, which is next week. So we talked about all of that. Let's see. Remember, there are 3 stages of inventory: raw materials, work in process, and finished goods. So part of what makes this chapter challenging is every time something gets transferred from one department to another, we have to keep a record of that, right? So anytime you take some materials and you start adding them to production, that goes into a certain account. What was that account called when we're working on a product?
Work in progress.
Work in process, correct. And then once the product is finished, what category does it go into? Which inventory account when it's finished?
Finished goods.
Finished goods, okay. And then once we sell it, then what account is that?
Cost of goods sold.
Cost of goods sold, right? So inventory moves through those stages: raw materials to work in process to finished goods to cost of goods sold, which is an expense. We know the difference between prime and conversion costs, right? And direct labor falls into both categories. So really what we're talking about is production-related costs, right? All of the production-related costs go into cost of goods sold. So when you look at an income statement, start with revenue, right? Subtract your cost of goods sold, and that gets you your gross profit margin. Then after that, that's when you take out the selling and administrative costs that didn't have to do with production, right? So those get separated out on the income statement. All right. So the 3 parts of production costs were direct labor, direct materials, manufacturing overhead, right? What goes into manufacturing overhead?
Like the electric bill, rent.
Okay, electric bill for the factory or production facility, rent for the production facility, and really anything that's related to production that is not direct materials and not direct labor goes into manufacturing overhead, right? So it's a really big bucket of an account that we just keep dumping things into. Okay, and skip a lot of this. We saw what a materials requisition form might look like. That is used to keep track of where the materials that came out of the storeroom went, who authorized them, so that you don't have things disappearing. Obviously, then all of the accounts have to be updated. So if you've got some materials that are now in production, they're going to come out, they're going to get credited out of their accounts, and they're going to go into work in process, right? And that is what accounting has to do to keep track of that. With labor, when you have labor costs, those also get added to work in process. So think about it like this. You always start with the materials when you're producing something, and you add some human labor. You might add extra materials that are somehow enhancing the product, but not to create more units. So for example, if I take enough wood to make 100 tables, and then maybe I need to get some extra wood, for finishing on the tables or some part of it, that's adding more material cost. But if I want to start a whole new batch of tables, then I go back and I get more wood to start a whole new batch, right? So sometimes we add materials, but we're not increasing the number of units. It's just some other reason. Again, like the sprinkles on the donut, or what would be another example? In the packaging department, they might need cellophane or shrink wrap to wrap the finished product. Well, that's a material. So sometimes we add materials to units that are already in progress. So we add materials, sometimes we add labor, pretty much all the time, unless you have a completely automated process. And then we have to, once we're done with the product, excuse me, then we add the overhead, right? Why do we have to wait until the product is finished to add the overhead? Exactly. We need to know either machine hours, direct labor hours, or direct labor costs, because those are the three traditional methods we use to estimate overhead. 2 chapters from now, we'll get into some other methods, but those are the ones we're going to stick with for now. Direct labor costs, direct labor dollars, and machine hours. No, I just said that wrong. Direct labor hours, direct labor cost, and machine hours. Okay. And we saw what time tickets look like, and the important thing to realize here is that each production worker might work on multiple jobs. So if you're doing job order costing, they have to keep track of how much work they did on each job, so you know how much labor costs to apply. And here we see how both the material costs and the labor costs have been added to this work in process inventory. Remind me, what type of account is work in process inventory? Asset, liability, or equity?
Asset.
It's an asset, right? And we keep adding to it because that inventory gets more and more valuable the more we put our materials, labor, and overhead into it. Okay, so in terms of estimating overhead, there's a formula for that, right? You have to take your annual overhead, whatever you think is going to be your overhead for the year, decide if you're using direct labor dollars, hours, or machine hours, and then estimate that. And then when you divide, you end up getting an overhead rate. Here it says overhead allocation rate, but I usually just leave out the middle word. And so that overhead rate, at the end of the job, you just multiply by the direct labor costs, hours, or machine hours, to know how much overhead to apply, right? That is the process. And once you do that, and you know how much overhead to apply, that comes, excuse me, comes out of the manufacturing overhead account, and it goes into work in process inventory. So now we have added some material costs, some labor costs, and some overhead. So we could now transfer all those costs to finished goods inventory, because that product is done. Any questions so far? All right, and let's see what else. We looked at these formulas. Again, it's really the same formula that applies at every phase of inventory. It works, you can't see it, but that says raw material, work in process, and finished goods, right? In every case, if you take your beginning inventory and then add something to it, it could be purchases, it could be production costs, it could be cost of goods manufactured. So it just depends which stage of inventory you're in. You take out your ending inventory, and that tells you your total, right? Okay. So that is a useful formula. I also mentioned you can switch around these last two. So material available for use, if you subtract ending inventory, you get materials used, but you can switch those around. Subtract materials used, you get your ending inventory. And that applies with all these formulas. If you switch around the last two, you can find the missing number, if that is the number that you're missing. And we did that. Let's see. More examples. I think we need to revisit that. Oh yeah, we went through this one, right? We looked at each job, where it was in the process, was there beginning inventory and work in process? Did it get finished? Did it get sold? Okay. And then, is that as far as we got? Check. Yeah, that is it. Okay. Okay, any questions? Very good. What we see here is a job cost sheet for this company. So this is for one particular job, and this is where we can see all the costs for that job. Now, this is separate from the accounting records where the same information would be recorded. This is something that might be, used in the production floor where they're actually using this to help keep track as things go along. So we see a job number for this particular job. Who's the customer that we're making this for? They ordered 1 unit, their customer number, when we started it, when we finished it. All that information's on there. And we can see all the materials that went into this product, the number of units of each material times the price per unit. Labor, we can see all the hours of labor at what wage rate and a total. And then the overhead. And remember, in this case, they were taking the $66 of direct labor cost, multiplying it by their rate of $2.50 of overhead per every dollar of labor. And that's how they got their overhead rate. And then add it all together, we see the total cost for this job. And so this way we know exactly what that job, well, maybe not exactly because the overhead is estimated, but pretty close to the actual cost for this job. And then if we compare that to the revenue from this job, you can see we have a pretty healthy profit there. All right, so this really just keeps all the information together in one place. Any questions here? All right, then. Did we do problem 2? No? Okay, well, let's do that then. Okay, so let me do this. All right, you might want to pull up your problem set. And I might want to do that too. Okay. Excuse me. So we're on problem number 2 here. All right, this company has estimated overhead of $50,000. And they have estimated direct labor hours to be 5,000. This job has $70 in aluminum costs. Is that direct material, direct labor, or overhead? Direct material? I mean, the only way it would go into overhead is if it was indirect material, but that's quite a bit of aluminum. So I think we can probably, measure how much of it goes into the actual job. 2 hours of labor at $20 per hour. That's important. During the month, they have $50 of indirect material cost, $150 of administrative labor, $300 in utilities, $250 in depreciation expense. Now that administrative labor, that's a little confusing. What they mean here is within the factory, they have administrative labor, okay? So we are going to consider it to be part of the production costs, even though it's administrative because it's within the production department. If it was administrative at the corporate offices, then it would not be part of production. So we have to do 3 things here. Figure out the predetermined overhead rate based on direct labor hours. figure out the total cost of this job, and then figure out the total overhead that the company had for the month. Okay? Any questions about what you need to do here? Okay, then I'm going to pause the recording. I'll leave you to it. $66, you said? And 67 cents. So let's see, we had $50,000 of overhead. And then 5,000 hours of direct labor. So we just divide, right?
Yeah, it should be 10.
Okay, so $10.
We were doing it by the total of the month.
You included that overhead cost.
Yeah.
I see. Well, those are actual. So with overhead, there's the estimated overhead that you base your rate on. There's the applied overhead when a job is done and you apply the overhead cost. And then there's the actual overhead at the end of the year or period where you can look back and see what were the actual costs, not for each job, but for the entire company. So you have to remember there are three types of overhead: estimated, applied, and actual. So, okay, so $10 per what? Per direct labor hour, right? So the overhead rate is $10 per direct labor hour. We got that by taking the estimated overhead divided by the estimated direct labor hours. Okay, any question on that, part A? Part B, what is the cost of job 0325? So, how much?
110.
110, okay, that sounds close.
Maybe to add in.
Yes, we have to add in $20 of overhead. So it's 130 altogether, right? So let's break it down. We have direct materials, direct labor, manufacturing overhead. How much were the direct materials for that job?
It was 70.
70. And what was the direct labor? 40, right? Because it was 2 hours at $20 each. And then the other part was the overhead. So again, we take, since they're using direct labor hours, we take the 2 direct labor hours times the rate of 10. That comes out to 20. And then when you add those 3 together, that's when we get our total $130. Okay, does that make sense? And the last one, what is the overhead incurred during the month? So for that, all we have to do is just add up those other overhead costs that they gave us, $50 here, plus 150, plus 300, plus 250. I think that comes up to $750. That sound right? Now, those are just general manufacturing overhead costs. We don't know what jobs those will get applied to, right? So those would just get journalized as part of manufacturing overhead. Okay, let's double check our answers here. And yes, we had $10, $130, and $750. All right. Okay, any questions? Right. Oh, now, we've done that one, right?
Yes.
Okay. Then moving on. There we go. Oh, looks like we're about to do another problem. I'll just stay right here. Okay, so this company has the following costs. What is the cost allocated to job A? All right, so looking at the information here, they bought some raw materials. Are those materials for job A?
No.
They're just materials. However, the next line says they issued some raw materials inventory to job A. So those costs are specifically associated with that job. Then they incurred some factory wage expenses. Okay, that just means that they counted up how much their workers worked, but they haven't allocated to any jobs until the next line. They allocated $2,000 to job A. And they allocated some of their factory wages to overhead. Why would we do that? What's that? No. Oh, why would factory wages go into manufacturing overhead?
Overtime.
Maybe like a sanitation,
Would be what?
like a cleaning.
Okay, yes, so it'd be indirect labor, right? If it's indirect labor and it's not going into a specific product, then it would go into manufacturing overhead. Then they incurred some manufacturing overhead costs, and then they allocated some manufacturing overhead to that particular job. So now, based on what we know, what is the total of the costs that have been allocated to job A? Yeah, we had 3,000 in materials, 2,000 in wages, 1,000 in overhead, so it's a total of 6,000. Okay, good. All right, so now problem 3. All right. Go to the problem set again. Okay, so this company is estimating 900,000 of overhead for the year. And they're not sure if they should use direct labor hours, which they're estimating to be, to be 60,000, or if they should use machine hours of 30,000 to allocate overhead. So let's do a comparison. Now, the material costs are 1,550. That's going to be the same in both scenarios. So whether we're allocating overhead by labor hours or machine hours, that doesn't impact materials, right? That only impacts overhead. So we'll put the same materials in both columns. And their direct labor costs, it says that they've got 90 hours of direct labor and 75 machine hours. Okay, the wages are $16 per hour. So how do we figure out our labor costs? Okay, so we'll take the labor rate. That's not a calculator, is it? What happened to my calculator? I wanted a calculator and I pulled up 1, 2, 3 movies, whatever that is. I don't even know what that is. Okay, so $16 per hour times 90 direct labor hours. Our labor costs are $1,440. And again, that's going to be the same in both scenarios. Right, because the only difference is we're trying to decide if we should base overhead on labor hours or machine hours. So let's calculate both. We'll come up with a total cost for the job in both scenarios. So that's your job now. Figure out what would the overhead be if they base it on labor hours. What would the overhead be if they base it on machine hours, and then total up each column. Okay, any questions on what you need to do? Okay, all right, we'll go ahead and work on that then. Okay, so if we take the overhead that we just calculated, I'll start with machine hour overhead. Okay, what did I do? Okay, I'll start with labor hours. So we take the machine hours. Yeah, I'm sorry. Let's try that again. We'll take the materials plus the labor plus the overhead that we calculated based on labor hours. We get a total of 4,340. Is that right?
Yeah.
Okay. And then again, our material and labor costs stay the same. And now we have calculated the overhead based on machine hours. We got 2,250. And so now 5,240. Does that look right? Okay. So we see that, excuse me, in this case, using machine hours does result in a higher overhead cost and a higher total cost. So we are done with the problem, but what do you think? If you were the company, which approach should you go with? The labor hours or machine hours as your method of applying overhead? How many people would go with labor hours? Okay, I see a handful of hands. How many people would go with the machine hours? Okay, it's about the same. So, which is right?
The machine hours.
You say machine hours?
It's a more conservative estimate.
Okay. So Jordan's saying machine hours is more conservative. That follows the principle of conservatism because it is a higher amount and makes us less profitable. Somebody want to make a case for labor hours and why that would be a better choice? Ultimately, I think what you want to do is really pick the activity that best represents your actual overhead costs. So I think I mentioned on Tuesday, if your company uses machines a lot in production, then maybe you use machine hours because that would be a better way to know how much overhead you're using, right? Because the machines use electricity. They have to be probably insured and maintained, and all those goes into overhead. Whereas if your company uses a lot of labor in production, then you'd probably want to use either labor hours or labor costs to estimate your overhead. Okay, so it really is up to the company, but I think just shooting for accuracy, trying to be as accurate as possible would be the better way to go. Okay, any questions on this problem? No? All right. Then let's see where we're at. Overhead, over applied and under applied overhead. So let's talk about that. Move this back. Okay. Told you that there are basically three types of overhead that we're dealing with. We have our estimated overhead. That's the amount that we estimate for the year, and that's what we use to come up with our rate, right? And we have our applied overhead, because once we have a rate and the job is done, we can actually apply a certain amount of overhead to that job. And then I said that there was a third type of overhead. Does anybody remember, other than estimated and applied?
Actual.
Actual, exactly. So looking back to see what were our actual overhead costs for the year, then you know. And as I mentioned, you don't go back and adjust individual jobs, but you would have to adjust your cost of goods sold and your manufacturing overhead accounts. Okay, so when you get to that point, when you know your actual overhead for the year, if it was greater than what you applied during the year, then you have over applied your overhead. Kind of hard to say. Sorry, something keeps tickling my nose. It's not running, it's just tickling. And then if the actual overhead is less than what you applied during the year, then you have under applied. Is that what I said? No, then you, did I say it backwards? I think I did. So if your actual is greater than what you applied, you're under applied. If your actual is less than what you applied, then you over apply. Makes sense, right? Yeah. So that is something that we'll have to be thinking about. In fact, I think we have an example here. So here's a case where overhead has been under applied. So as we went through the year and we applied a little bit of overhead to every job, we got to the end of the year, we looked at the total amount that we had applied, and it was less than the actual overhead. So we under applied. So then what you have to do is you have to increase your cost of goods sold by the amount that you were off. so that you have the correct cost of goods sold for the year. And you would also correct your manufacturing overhead. Right? Because that's how we apply it. We take it out of manufacturing overhead and we put it into work in process, and then eventually it ends up in cost of goods sold. So if we're correcting it, these are the accounts we have to correct: cost of goods sold, manufacturing overhead. Now, if we have over applied, so the total that we applied during the year was too much compared to the actual overhead, then we do the opposite. Then our manufacturing overhead has to go up and cost of goods sold has to go down. And if you get confused on that, you can always look in the textbook or look at this slide to help you straighten that out. Okay? So questions or comments? Emma?
It's important to review the overhead part of, like, to take into consideration for the sale price, right? Also.
Mm-hmm. Yeah, exactly, right. That's what we're doing is we're estimating the overhead to figure out our cost of goods sold. Right, it's going into work in process, but that goes into finished goods, and then that goes into cost of goods sold. So all that overhead that we're applying ends up in cost of goods sold. And if we apply too much, then we need to reduce our cost of goods sold. If we didn't apply enough, then we have to increase our cost of goods sold. So that gives us an accurate understanding of how much was the cost of goods sold for the year, right? Yep, so that's why you want to be fairly accurate so that you're not going to have to make major corrections at the end of the year. The managers like to know roughly what their overhead costs are, and that's why we want a fairly accurate rate that we can use throughout the year. Any other questions? Okay. So let's see, this company, okay, this is their actual overhead, and this is what they had estimated. So notice that their actual overhead was $6,500 more than what they had estimated. So now to correct it, they have to increase their cost of goods sold and decrease their manufacturing overhead, right? Because the estimate is what we use to actually apply the overhead. In this case, we're under applied. Oh, another problem. Okay, let's do this one. Yeah, okay, this one looks easy. Not really as easy as it looks. Okay. So this company estimated their annual overhead to be $85,000, and they based that estimate, they based the overhead rate on 24,286 direct labor hours. It's a very specific number that they came up with. Now, at the end of the year, actual overhead was $90,000. And the actual direct labor hours were 24,100. So we have to figure out how much were they over applied or under applied. Now keep in mind, again, there are three types of overhead, right? There's the estimate that we use to come up with a rate, but then we actually apply that. How do we apply the overhead to the finished jobs? Yeah, exactly, by either the hour or the labor costs, right? So in this case, since they're using labor hours, it would be by labor hours. So to figure out the amount that they applied during the year, you're going to need first a rate. And then the rate gets multiplied by the actual hours, right? Not the estimated hours. The rate gets applied to the actual hours. And then you'll know how much they applied. And then that you can compare with the actual overhead. Okay, so figure out the rate, figure out how much they would have applied during the year, and then how different that is from the actual overhead. Okay, good luck. Okay. So here's the answer. Let me review that one more time for the recording. So we had to figure out our overhead rates, right? It's good review, right, for everybody. We took the estimated overhead divided by the estimated direct labor hours to get our rate. We multiplied that by the actual direct labor hours to know how much we applied. And then we see that that was less than the actual manufacturing overhead. So we were underapplied, and we had to increase our cost of goods sold to correct it. Okay, any questions on problem 8? All right then. So prepare journal entries for a job order cost system. Okay, so journal entries are easy, right? We know how to do those. Let's go ahead and just take a look at what's going on all the way through the process, starting with the direct materials. What that was. Okay. So the company bought some materials, right? They haven't paid, so it's an account payable, and they have the materials. Then some materials are requisitioned into production. So they come out of the materials accounts. Where do they go? Work in process, right? Because once they hit the factory floor, they become part of a particular job. And we've got some labor costs. So now notice here, some of the labor is going into a specific job. We can see the job number. And some of the labor is also going into a specific job, okay? But it's just a different amount. All right. And then some of the labor is going into manufacturing overhead because it's indirect labor and it's not directly associated with the specific job, right? And then later, out of manufacturing overhead, we'll apply whatever has to go into that particular job. So that happens later. Okay, we also have some indirect materials. So we see we've used some supplies. We have some utility expenses. We have some depreciation. We have some prepaid insurance we've used, and we owe some interest on a loan related to something having to do with production. So maybe a loan for equipment or something like that. Now, all of these costs, notice they all just get lumped into manufacturing overhead, right? Just one account for all of those different costs. And then at the end of the job, once it's complete, that's where you take the manufacturing overhead and you put it into work in process inventory based on your rate, right? In this case, it was direct labor dollars times the overhead rate, and that's how they came up with the $165. Then you can transfer the entire cost of that job out of work in process into finished goods because you now have a finished product. Then when it's sold, it comes out of finished goods into cost of goods sold, and then you also journalize the actual sale, right? So that's the process all the way through. And here we, at the end of the year, okay, so we have to adjust our cost of goods sold. Let's look at what happened here. Was the company underapplied or overapplied?
Underapplied.
They were underapplied, exactly. So that's why they have to increase cost of goods sold to correct it. All right, yeah, let's work through this one together. Go back over here. Okay, Kraken Board Sports. This company has come up with these overhead costs, right? This is all overhead. And let's total that up to see what is their total overhead. Get bigger. All right, can you see that okay? So let's add up all those overhead costs in the top right. $209,250. I will put that. Don't really have a lot of room. Let's see. I know. Um, 209,250. Okay, that is the total of those overhead costs. Yep. Okay, so let's see what's going on here. Let's see, they make winches for snow and ski boarders to snow ski. Okay, I'm not really sure what that means, but that's all right. So end of the year, show these expenses above. So okay, so these are actual overhead expenses up here. They had 6,240 direct labor hours. So would that be actual or estimated? Actual, right? If it says had, then we know that's what they had. It's actual. And they had a rate of $33.50 of overhead per direct labor hour. So how much overhead was either over applied or under applied during the year? How can we figure that out? Okay.
That would come up to $209,000. $209,040.
Okay, I believe you. I'm just having a technical problem here. Okay, there we go. That worked. Oh, I have to stop this. Okay. All right. So, how did you get that?
So I took the rate, which is $32.50
Mhm.
per direct labor hour, and I multiplied that by the direct labor hours we were given, the actual ones.
Okay. So they would have applied $209,040 of overhead compared to the actual overhead we saw up here. And so we can just take the difference. You see, it's a difference of $210, right? So were they over applied or under applied?
Under,
They were under applied by $210. Okay. And so how would we then journalize that?
Debit costs of goods sold.
We would debit cost of goods sold, we would credit manufacturing overhead. Okay. All right, good job, everybody. Oh, I have to get rid of this now. There we go. Okay. So let's say a company has had over applied overhead for each of the last 5 years. So every year they applied too much overhead during the year. What would you suggest to them?
instead of,
What's that?
Under-applied.
Under applied, balance things out. What were you gonna say, Alexandra? No? Well, okay, so I mean, obviously they're, it looks like their estimates are not very good. So how might you correct that?
You might not need.
Okay. If it's over just a little bit, maybe it's not a big deal.
If it's a little bit over, then it doesn't matter. If it's
Okay.
significant pricing, then it might.
Right, so if it is a significant difference, we might want to fix that. What could they do differently to try to be more accurate? Okay, do better analysis of last year's overhead costs, how much they think it'll change this coming year based on increased production or
I wouldn't do
whatever.
last year, I would do all 5 years.
5 years,
See
yeah.
The full difference.
Good
and
point.
If it was increasing or decreasing, much of the difference.
That's true. If you look at multiple years, you could see trends and see, hey, our widget costs are going up, but our energy costs are going down or whatever, and make appropriate corrections. Okay, good. All right, we are near the end here. Oh, yes. So in this example, it's a TV repair shop. We're going to apply the same concept of job order costing, excuse me, to a service company. So let me move back over there. Recording, right? Yeah. Okay, so somebody brings in their TV to a repair shop and they pay to first have it diagnosed. So they pay $50 and the repair shop records that as diagnosis revenue, right? They earned it because they did the diagnosis. And then the person decides to authorize them to proceed with the repair. Now, the repair involved buying a new power cord. Apparently that was part of the problem. And so the company had to order the power cord or get the power cord from the supplier. So the TV repair shop now has an account payable that they owe to the supplier. And they also just debited repair in process. So notice in this case, it's not work in process because they're not making a product, they're doing a repair. Okay, and then the employee that's working on it, apparently they get paid a salary and $75 of their salary will be applied to this particular job. And again, that goes into the repair and process account. Then they apply some overhead. Notice that that also is $75. So maybe they're basing it on $1 per direct labor dollar. So it just happened to come out the same. Then when the job is complete, all of these 3 repair and process costs get added together and get credited over here, debited to cost of completed repair, the equivalent of cost of goods sold, right? And we got the revenue because customer paid cash and we finished the job. So same idea, just applied to a service company. Okay, questions, comments? Right then, well, I think our summary slide is next. Yep. Just have one slide, okay. So we have learned about job order costing. When you want to apply your costs to an individual job or an individual customer, we know that that involves the direct materials, direct labor, and the manufacturing overhead. Since we don't know exactly manufacturing overhead costs, we have to estimate it, right? We have to have a rate that we use to apply. We keep track of these costs as they go from raw materials to work in process, and there might be multiple departments that are part of that work in process, and then ultimately to finished goods. And then cost of goods, right? Once we sell it. And then we have to see, did we over apply overhead or under apply overhead, right? And if we did either, which, I mean, it's going to be very rare that a company got it exactly right? So there's basically always going to be either over applied or under applied overhead. So you make an adjustment to the cost of goods sold and manufacturing overhead accounts. And that service companies can also use job order costing. Okay. So you're now experts on job order costing. And I have no idea what time it is. I better check. 2:13. Okay, well, in that case,